There is a new tax deduction sitting inside federal law right now that could reduce a retiree's taxable income by as much as $6,000 per person every year. For a married couple over the age of 65, that number can reach $12,000. And yet millions of retirees have never heard of it. Not because it is hidden, not because it is difficult to claim, but because most people assume their tax situation today looks exactly the same as it did last year. That assumption may be costing them money. The reason this matters is simple. Retirement changes everything about how taxes work. A retiree may be receiving Social Security benefits, pension income, IRA distributions, interest income, or withdrawals from savings accounts. Each source interacts differently with the tax code. Small changes in deductions can have surprisingly large effects on the final amount owed to the IRS. And beginning with the 2025 tax year, Congress added a new deduction specifically for Americans age 65 and older. For some retirees, it may reduce taxable income by thousands of dollars. For others, it may help eliminate federal income tax liability entirely. The surprising part is not that the deduction exists. The surprising part is how many retirees continue filing returns exactly as they did before, never realizing the rules have changed. Tonight, we will examine 6 expenses and charges that many retirees continue paying out of habit, even when federal law, Medicare regulations, state programs, or existing exemptions may allow them to pay less. Some of these savings opportunities apply primarily to lower-income retirees. Others apply to homeowners, pension recipients, and retirees with substantial savings. But every one of them comes down to the same principle. The government does not automatically stop these charges for you. You have to know the rule exists before you can benefit from it. And the first rule may be one of the most overlooked retirement tax changes in years. Let us begin with the first expense on our list because it may be the most misunderstood. Federal income tax. Most retirees assume that once they leave the workforce, their tax situation becomes simpler. In reality, the opposite is often true. A working American typically receives one primary source of income and a standard W-2. A retiree may receive Social Security benefits, pension payments, required minimum distributions from retirement accounts, interest income, dividends, and investment withdrawals, all of which interact with the tax code differently. That complexity is precisely why so many retirees miss deductions they legally qualify for. Beginning with the 2025 tax year, federal law introduced a temporary additional deduction specifically for Americans age 65 and older. The provision allows qualifying retirees to claim an additional deduction of up to $6,000 per person. For married couples where both spouses are age 65 or older, the deduction can reach $12,000. And this is where many people become confused. The deduction does not replace the standard deduction. It does not replace existing age-based deductions. It is added on top of them. That distinction matters because deductions reduce taxable income before taxes are calculated. The lower the taxable income, the lower the potential federal tax liability. The full deduction is generally available to single filers with modified adjusted gross income up to $75,000, and married couples filing jointly with income up to $150,000. Above those thresholds, the benefit gradually phases out. The result is that a significant portion of middle-income retirees, not just low-income households, may qualify for the full benefit. But federal income tax is only one piece of the puzzle. The second area many retirees misunderstand is the taxation of Social Security benefits. There is a widespread belief that Social Security is always taxed. There is an equally widespread belief that it is never taxed. Neither statement is entirely correct. The IRS determines whether Social Security benefits are taxable using a calculation known as combined income. Combined income generally consists of adjusted gross income, certain non-taxable interest income, and 1/2 of annual Social Security benefits. That figure is then compared against federal thresholds. For some retirees, none of their Social Security benefits are subject to federal income tax. For others, a portion becomes taxable. At higher income levels, up to 85% of benefits may be included in taxable income. Notice the wording carefully. Up to 85%, not 100%. Even at the highest income levels, a portion of Social Security remains outside federal taxation. The next compliance issue involves withholding. Many retirees elected federal withholding from their Social Security checks years ago and have never reviewed that decision again. As tax laws change and deductions increase, withholding elections that once made sense may no longer reflect actual tax liability. Some retirees continue having money withheld throughout the year, only to discover later that they owed little or no tax at all. The government eventually returns the excess through a refund, but the retiree spent the entire year without access to that cash flow. The fourth area involves Medicare, specifically Medicare Part B surcharges known as IRMAA, the Income-Related Monthly Adjustment Amount. Many retirees are surprised to learn that Medicare often uses income information from 2 years earlier when determining current surcharges. That creates a common problem. A worker retires, income falls dramatically, but Medicare may continue assessing surcharges based on earnings from the final working years. Federal regulations provide a process for appealing those surcharges when a qualifying life-changing event has occurred, including retirement itself. Yet many retirees never file the required paperwork because they are unaware the option exists. Finally, there is the issue of property tax relief programs and Medicare supplement costs. Many states offer senior exemptions, assessment freezes, valuation caps, or relief programs that reduce property tax burdens for qualifying homeowners. Likewise, Medicare supplement plans providing identical standardized coverage can carry dramatically different premiums depending on the insurer. In both cases, the challenge is not eligibility, the challenge is awareness. And that brings us to the central theme connecting every item discussed today. None of these benefits arrive automatically. The tax code assumes taxpayers understand available deductions. Medicare assumes beneficiaries know appeal procedures. Property tax programs assume homeowners will apply. Insurance companies assume customers will comparison shop. The burden of action remains with the retiree, and that is why understanding the rules often becomes just as valuable as the money itself. Understanding the rules is important. Understanding the cost of ignoring them is what changes behavior. Because retirement planning is ultimately a game of arithmetic, most retirees do not lose money through catastrophic mistakes. They lose money through small leaks that continue year after year, often unnoticed. A few $100s here, a few $1,000s there. Over a decade, those amounts become substantial. Let us start with the new senior deduction. Consider a married couple, both age 67, receiving a combined annual income of $95,000 from Social Security benefits, pension payments, and retirement account withdrawals. Under the current rules, they may qualify for the full $12,000 additional deduction. That deduction does not put $12,000 directly into their bank account. Instead, it reduces the amount of income subject to federal taxation. Depending on their tax bracket, that could translate into hundreds or even thousands of dollars in annual tax savings. Now multiply that benefit across the 4-year period currently authorized under the law. What appears to be a modest deduction can become a meaningful retirement asset. Next, consider Social Security withholding. Imagine a retiree receiving $2,000 per month in Social Security benefits. Years ago, they elected to have 10% federal tax withholding applied to every payment. That means $200 is withheld each month. Over 12 months, that amounts to $2,400. If changing deductions and income levels result in little or no federal tax liability, that retiree has effectively spent the entire year without access to $2,400 of their own money. Yes, the government may eventually return it as a refund, but the retiree has already lost the opportunity to use those funds for living expenses, savings, or interest earnings throughout the year. Now let us look at Medicare surcharges. This is one of the most expensive mistakes retirees make because the monthly amounts appear small at first glance. Suppose a retiree's income drops significantly after leaving the workforce, yet Medicare continues calculating premiums using income information from 2 years earlier. An IRMAA surcharge of just $220 per month creates an annual cost of $2,640. If that error continues for 2 years, the retiree has spent more than $5,000 unnecessarily. Not because the surcharge was fraudulent, not because Medicare made a mistake, simply because the retiree never filed the paperwork needed to update their income information. Then there is Medicare supplement coverage. Many retirees assume that staying with the same insurance company is the safest option. But standardized Medicare supplement plans are exactly that, standardized. A Plan G policy is required to provide the same core benefits regardless of the carrier offering it. If one company charges $64 more per month than another for identical coverage, the difference becomes $768 per year. Over 10 years, assuming rates remain relatively similar, that retiree has paid an additional $7,680 for the same protection. No additional benefits, no additional services, simply a higher premium. Property taxes create another silent drain. Even modest exemptions can have a surprisingly large impact over time. A homeowner receiving only $1,000 per year in property tax relief may save $10,000 over a decade. For retirees living on fixed incomes, that amount can cover major home repairs, prescription expenses, insurance premiums, or emergency medical costs. And unlike investment returns, those savings arrive with no market risk. There is one final expense many people dismiss because the amount appears relatively small: tax preparation fees. Suppose a retiree pays $350 every year to prepare a straightforward return. Over 10 years, that totals $3,500. Over 20 years, the total reaches $7,000. Again, not because the service lacks value. Complex situations absolutely justify professional assistance. But many retirees continue paying for services they no longer need simply because they have never reviewed their options. Notice what all of these examples have in common. None involve speculative investments. None require predicting the stock market. None depend on interest rates, economic growth, or future returns. They are based entirely on understanding existing rules and reducing unnecessary expenses. This is why successful retirement planning often looks different from wealth accumulation. During working years, the goal is typically maximizing income. During retirement, the goal increasingly becomes protecting income. Every unnecessary dollar that leaves a retiree's balance sheet must eventually be replaced by withdrawals, savings, or investment returns. A retiree who eliminates $3,000 of annual waste has effectively created the same spending power as someone who generated an additional $3,000 of after-tax income. And in many cases, reducing unnecessary expenses is far easier than generating new income. That is the hidden mathematics behind today's discussion. The danger is not a single large bill. The danger is a collection of small overpayments that quietly compound year after year until thousands of dollars have disappeared without anyone noticing. At this point, the most important question is not whether these savings opportunities exist. The most important question is whether they apply to you. And fortunately, that answer can be determined in less than a week. The first step is reviewing your most recent federal tax return. Locate last year's return and identify 3 numbers: your adjusted gross income, your taxable income, and your total federal tax liability. Those 3 figures will tell you whether the new senior deduction is likely to produce meaningful savings and whether your current withholding elections still make sense. If you use a CPA or tax preparer, ask a direct question. Was every age-based deduction available to me applied on my most recent return? Do not assume. Verify. The second step involves Social Security withholding. Review your annual Social Security statement or your most recent benefit records. Determine whether federal taxes are currently being withheld from your monthly benefit. If they are, compare that withholding amount to what you actually owed on your most recent federal return. For some retirees, the withholding remains appropriate. For others, it may be unnecessarily reducing monthly cash flow. The third step concerns Medicare. Look at your current Medicare Part B premium and determine whether an IRMAA surcharge is included. If your income has fallen significantly since retirement, review whether Medicare is still using income information from years when you were working. Many retirees never revisit this issue after enrollment, yet retirement itself may qualify as a life-changing event under Medicare's adjustment process. The fourth step is property taxes. Contact your county assessor's office and ask a simple question. What property tax relief programs are available for homeowners age 65 and older? Not next month, not next tax season, this week. Many exemptions, freezes, and relief programs require an application. Eligibility alone is not enough. The application must be filed. The fifth step is reviewing your Medicare supplement coverage. Pull out your most recent premium statement, determine which plan letter you currently have, then compare that premium against alternative carriers offering the same standardized coverage in your area. Many retirees are surprised to discover that identical benefits can carry dramatically different price tags. The sixth and final step involves annual tax preparation costs. If your return is relatively straightforward, review whether free or low-cost, senior-focused tax assistance programs are available in your community. The goal is not to avoid professional advice. The goal is to ensure you are paying for expertise only when expertise is actually needed. Now, I want to leave you with one final thought. None of the 6 expenses discussed today are examples of fraud. None are examples of government mistakes, and none involve secret loopholes. They exist because retirement rules are complex, programs change, deductions evolve, and most people are too busy living their lives to track every update. The problem is not that the opportunities are hidden. The problem is that nobody sends a personal invitation reminding retirees to claim them. The responsibility ultimately falls on the individual, and that may be the most valuable lesson in retirement planning. The difference between paying a bill and avoiding a bill is often nothing more than knowing the rule. A deduction not claimed provides no benefit. A property tax exemption not requested provides no savings. A Medicare surcharge not challenged continues to be collected. Information alone does not create results. Action does. As always, this discussion is intended for educational purposes only and should not be considered individualized tax, legal, Medicare, or financial advice. Eligibility requirements, deduction amounts, tax treatment, Medicare rules, and property tax programs vary by state, income level, and individual circumstances. Before making any financial decision, consult the appropriate qualified professional. For now, take an hour this week and review these 6 areas, because the easiest money to keep is often the money that should never have left your pocket in the first place. Thank you for watching. Stay informed, stay vigilant, and most importantly, make sure every dollar you worked a lifetime to earn is working just as hard for you in retirement.